So, how do you take money out of a limited company in the most tax efficient way? What a great question, and it's something that Louise and I discuss in this video. So Bala and Rick, funny enough, have asked the same question.
Hi Bala, hi Rick.
Hello Bala and Rick, hopefully you're watching tonight. They have asked the same kind of question.
Okay.
How to take money out of a limited company. So
all these questions, they could be an hour long on their own.
They could be, but
awesome.
we're not going to do that. I'll leave that delay, that deliberation with the property expert panel, which is the first Monday of every month
at 7 p.m.
At 7 p.m, not 8 p.m. So I'll leave that with them guys. But for us, we're going to keep it short and sort of concise. I think that's the best thing about this channel. It's only an hour long.
It is.
So if you've got a limited company that's got all the rental income from these properties, it's generating a lot of profit and therefore cash, it sits in the business bank account. What people don't always appreciate is that the money in that bank account owned by the business, it is not owned by you. So we do see a lot of times when people have this money in their limited company and then just take it out and not think about the tax consequences. So how can people take money out of a limited company without going through the 20-point checklist that we've got in our tax notes? But what are the most common things that people can do?
I would say there's probably three buckets in the ways that you can take. If I jump at the highest level for me, the first bucket is to take out pure cash. And typically that's going to be either as a form of salary, maybe as a portion of dividends, if your company has made enough profit to do so. Dividends can only be taken on profits. And maybe even perhaps paying back some directors' loans that you have given the company over time. So that's one method. The second method is not really getting the cash, but having the company pay for something for you that otherwise you would have had to put your hand in your own pocket to pay for. So there may be some forms of medical expenses that you've got to incur that your company could pay for legitimately. There may even be opportunities to have the company secure certain things for you. So things like, it's a very simple one and it's a relatively small one, but I love it to bits. Christmas do. Wouldn't we all like that Christmas do? The company can pay for that up to a certain value for each of the employees. So in effect, the company is paying for you to go out and have a lovely time, which you would have hopefully done at some point anyway, particularly today. 19th, everything opening.
Yes, everything opening.
Careful.
Did you mention pensions by any chance?
Well, I love the fact that you're mind reading. That was my third thing, because for me, that next bucket is thinking about your future. And the company can actually contribute massively to your pension pot. And it's a double winner, chicken dinner, because not only are you, in effect, not having to put your own hand in your pocket to pay that pension contribution, but your company is going to be able to treat that pension contribution as though it was an expense, which brings down the profit, which brings down corp tax. Yay!
Yeah. Even bigger for me, though, is inheritance tax. Because if you've got a property portfolio inside a limited company, and this is another misconception, is that people have properties in their own name, they move it to a company and they go, sure, I've cleaned my decks now of inheritance tax. But what people fail to realize is that properties inside of an investment limited company is still subject to an IHT. But if you then make those pension contributions, take it out of your business, put that £40,000, let's say, you get 19% tax relief, you put it to your pension, and then it sits there. The money grows in that pension tax-free. And when you die, you pass it on to your loved ones, again, IHT-free. So there's so many benefits of putting money into pensions. And I think it's a lost opportunity in many ways.
Because you can do so much with pensions as well. In order to make that growth that Simon's just described, there are opportunities to continue to develop your expertise and utilize your expertise in terms of property, albeit you've got to be very careful what you can invest in. That's a whole nother topic. But you can actually utilize that money in the right type of pension to go off and do everything you know how to do well, which is amazing.